EPFO stands for Employees Provident Fund Organization. It is a statutory body that provides social security to the employees of organized and unorganized sectors in India. EPFO administers the Mandatory Provident Fund, a basic pension scheme and a disability/death insurance scheme for its members. EPFO also manages social security agreements with other countries where bilateral agreements have been signed. One of the ways that EPFO invests in equities is through exchange-traded funds, ETFs. ETFs are funds that track the performance of a basket of stocks or an index, such as the Sensex and Nifty. ETFs can be bought and sold on stock exchanges like shares. ETFs offer diversification, low cost and transparency to investors. EPFO started investing in ETFs in August 2015 with an initial allocation of 5% of its investable surplus. This was gradually increased to 15% in 2018. EPFO invests in two ETFs that track the Sensex and Nifty, namely SBA ETF Nifty 50 and UT ETF Nifty Next. EPFO also invests in CPSE ETF and Bharat 22 ETF, which are based on public sector enterprises and strategic holdings of the government. EPFO's investment in ETFs aims to boost its equity exposure and generate higher returns for its members in the long term. EPFO claims that its investment in ETFs has yielded an average return of 14.74% since inception till March. EPFO also plans to introduce an option for its members to choose their own asset allocation between debt and equity, depending on their risk appetite and financial goals. The Employees Provident Fund Organization, EPFO, is a statutory body that manages the retirement savings of millions of private sector employees in India. The EPFO invests the money collected from its subscribers in various instruments to generate returns and pay interest to its members. One of the instruments that the EPFO invests in is equity. Equity is a type of investment that represents ownership in a company or a fund. Equity investments can offer higher returns than debt investments, but they also carry higher risks and volatility. The EPFO started investing in equity in 2015, when the government allowed it to invest 5% of its annual incremental deposits in exchange-traded funds, ETFs. ETFs are funds that track the performance of an index, such as Nifty or Sensex, or a basket of stocks, such as CPSEs or Bharat. ETFs are listed on stock exchanges and can be bought and sold like shares. The EPFO gradually increased its equity allocation to 15% of its annual incremental deposits by as of March 31, 2021. The EPFO had a total of Rs 122,986.40 crore of investment in ETFs, which had a notional value of Rs 160,017.14 crore, reflecting 14.67% returns. This means that the EPFO's equity investments have increased 5 times in 6 years. The EPFO's equity investments have also given higher returns than its debt investments. In the last 5 years, the average return on investments in Sensex and Nifty is 18%, while the government debt and highest-rated corporate yield stood at 6.8% as of March end. On the other hand, the return on EPFO's debt investments was 6.78% in FY21 and 7.5% in FY. It was 8.5% in FY. The objective of EPFO's investments in equities was to provide good returns to its subscribers in the long term. An analysis shows that equity markets have given higher returns than the debt markets. However, the EPFO has also been cautious and conservative in its equity exposure. It does not invest in actively managed equity mutual fund schemes or directly in stocks. It only invests in ETFs based on Nifty 50, Sensex, CPSEs and Bharat 22 indices. It has also redeemed ETF units twice, once each in 2020, and the EPFO may consider increasing its equity investment limit to 25% to bridge the shortfall in returns due to lower interest rates on debt instruments. However, this decision will depend on various factors, such as market conditions, risk appetite and member preferences. The EPFO will also have to balance its equity investments with its other obligations, such as paying interest to its members and maintaining adequate reserves.